Hello fellow compounders, welcome back. Today we're diving into the world of closed end funds, or CEFs for short. We'll compare them to ETFs and mutual funds, discuss what to look for when investing in closed end funds, and share some strategies to maximize your investments. Plus, we'll take a closer look at two closed end fund ETFs that offer dividend yields above 8.5%. So grab a cup of coffee, sit back, and let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. Now let's compare closed-end funds to mutual funds and ETFs. All three of them are baskets of stocks or other assets. Mutual funds are open-ended, meaning that they continuously issue new shares and redeem existing ones based on investor demand. This ensures that the fund's price per share, or net asset value, closely matches the value of its underlying assets. ETFs, or exchange-traded funds, also trade on the stock exchange like closed-end funds, but they have a creation and redemption mechanism that keeps their market price in line with their net asset value. Authorized participants can create or redeem large blocks of ETF shares directly with the fund, ensuring that the market price stays close to net asset value. Closed-end funds, on the other hand, have a fixed number of shares and no creation or redemption mechanism. This means that their market price can fluctuate above or below their net asset value, leading to premiums or discounts. Speaking of premiums and discounts, this is one of the unique aspects of closed-end funds. The market price of a closed-end fund can trade at a premium, that means above its net asset value, or at a discount, below its net asset value. Savvy investors often look for closed-end funds trading at a discount, hoping that the discount will narrow over time, providing an additional boost to their returns. One important aspect to consider is the impact of market sentiment on the trading price of the closed-end fund. Because closed-end funds trade on the open market, their prices can be influenced by investor sentiment, market conditions, and even the performance of the underlying assets. This can create opportunities for investors to buy closed-end funds at a discount or sell them at a premium. Historically, closed-end funds often trade at a discount to their net asset value. For example, during market downturns, discounts may widen as investors become more risk-averse. On the other hand, during bull markets, discounts may narrow or even turn into premiums as investor confidence grows. Understanding these dynamics can help you make informed decisions when investing in closed-end funds. It's crucial to do your homework and understand why a closed-end fund is trading at a discount or a premium before you make a purchase. So, what should you look for when investing in closed-end funds? Here are a few key points to consider. Number one, the discount to net asset value. As mentioned before, look for closed-end funds trading at a discount. However, don't just buy any fund because it's cheap. Make sure you understand why it's trading at a discount and whether it's likely to narrow. When assessing a closed-end fund trading at a discount, examine historical discount trends. Is the current discount wider or narrower than usual? Understanding the fund's historical trading pattern can provide insights into whether the discount is likely to persist or narrow. 2. Distribution rate. Closed-end funds are known for their high distribution rate or dividend rates. But be cautious. Make sure that distribution is sustainable and not just a return of capital. Look beyond the headline distribution rate. Analyze the fund's distribution policy to understand the sources of that distribution. Is it coming from income generated by the fund's investments, capital gains, or a return of capital? Sustainable distributions are typically funded by income and capital gains, while return of capital can be a red flag if it's not part of the planned strategy. Number 3, leverage. Many closed-end funds use leverage to enhance returns. This can be a double-edged sword. While leverage can boost gains, it can also magnify losses. Leverage involves borrowing funds to invest, which can amplify gains but also increase risk. Check the fund's leverage ratio and understand how it impacts the fund's performance. Also, consider the cost of leverage and how rising interest rates might affect the fund. Number 4, management. Research the fund's management team. Experienced managers with a history of strong performance can add significant value. Look for consistency in achieving the fund's investment objectives and how they've navigated different market environments. Number 5, expense ratio. Closed-end funds typically have higher expense ratios than ETFs and mutual funds due to the active management and leverage cost. Ensure that the fund's performance justifies the higher expenses. Compare the expense ratio with other similar closed-end funds to gauge if it's reasonable. Number 6, liquidity. Liquidity is crucial when trading closed-end funds. Low trading volume can lead to wider bid-ask spreads, making it more expensive to buy and sell shares. Check the average daily trading volume and be cautious with funds that have low liquidity, especially if you plan to trade frequently. Let's review some useful strategies for investing in closed-end funds. Number 1, dollar cost averaging. Consider using a dollar cost averaging strategy where you invest a fixed amount of money at regular intervals. This can help mitigate the impact of market volatility and reduce the risk of making a large investment at market peaks. 2, pair trading. Pair trading involves buying a closed-end fund trading at a significant discount and shorting a similar closed-end fund trading at a premium. This strategy aims to profit from the convergence of the discount and premium. However, it's complex and requires a good understanding of both funds and the market dynamics. Number 3, sector rotations. Closed-end funds offer exposure to various sectors and asset classes, so consider rotating your investments based on economic cycles. For example, during economic expansions, you might favor equity-focused closed-end funds, while during recessions, you might shift to fixed-income closed-end funds for stability and income. 4, activist investing. Some investors look for closed-end funds with significant discounts and potential for activist involvement. Activist investors may push for changes to unlock value, such as improving management practices or merging it with other funds. This strategy requires in-depth research and understanding of the fund's structure and potential catalysts. Number 5, rebalancing. Regularly review and rebalance your closed-end fund portfolio to maintain your desired asset allocation. This ensures that your portfolio remains aligned with your investment goals and risk tolerance. Rebalancing allows you to take advantage of market opportunities by selling overvalued positions and buying undervalued ones. Now, let's review 2 funds of funds that offer an easy way to invest in closed-end funds. These are PCEF and CEFs. Those are the tickers. PCEF, the Invesco's CEF Income Composite ETF. PCEF aims to provide income by investing in a diversified portfolio of closed-end funds that focus on fixed income securities, including investment-grade bonds, high-yield bonds, and senior loans. It's a passive fund that tracks the S-Network Composite Closed-End Fund Index. The index selects closed-end funds based on liquidity, dividend yield, and market capitalization. PCEF offers a convenient way to gain exposure to a broad range of income-generating closed-end funds with one investment. On May 14, 2024, PCEF closed at $18.56 per share with a dividend yield around 9.4%. Advantages. The advantages of PCEF are diversification across multiple closed-end funds, a focus on income, passive management, and regular distributions. Considerations. Higher expense ratio. It has a higher expense ratio compared to individual closed-end funds. Exposure to interest rate risk due to fixed income focus and potential for trading at a discount to net asset value. Our next fund, CEFs, the SAVA Closed End Funds ETF. CEFs is an actively managed ETF that seeks to provide capital appreciation and income by investing in closed-end funds trading at a discount to their net asset value. The fund's manager, SAVA Capital Management, uses a combination of fundamental and quantitative analysis to select closed-end funds with the potential for narrowing discounts. CEFs also employs hedging strategies to manage risk and enhance returns. On May 14, 2024, CEFs closed at $20.63 per share with a dividend yield of 8.5%. The advantages: active management, focus on discount narrowing, potential for capital appreciation, and income generation. Considerations: higher expense ratio due to active management's reliance on manager's skill, and potential for leverage risk in underlying closed-end funds. Both PCEF and CEF offer unique approaches to investing in closed-end funds. PCEF provides a diversified, income-focused strategy, while CEFs offers an actively managed approach targeting value through discount narrowing. Understanding the differences between these funds can help you choose the one that aligns with your investment goals and risk tolerance. Takeaways. So let's summarize the key points we've covered today. 1. Closed-end funds raise a fixed amount of capital through an IPO and trade on the stock exchanges like stocks. 2. Unlike mutual funds and ETFs, closed-end funds have a fixed number of shares and can trade at a premium or a discount to their net asset value. 3. When investing in closed-end funds, look for factors such as discount to net asset value, distribution rate, leverage, management, expense ratio, and liquidity. 4. Consider strategies like dollar cost averaging, pair trading, sector rotation, activist investing, and regular rebalancing. And 5. An easy way to invest in closed-end funds is through ETFs like PCEF and CEFs, 2 closed-end fund focused funds that offer different approaches to gaining exposure to the closed-end funds market. Investing in closed-end funds can be a rewarding strategy, but it's essential that you do your own research and understand the risk involved. And there you have it, a comprehensive overview of closed-end funds, how they compare to ETFs and mutual funds, what to look for when investing, and some strategies to help you succeed. Investing is a journey, and the more you learn, the better equipped you'll be to make informed decisions. Remember to always be compounding. See you in the next video. Take care.